What is income investing? Income investing is a strategy focused on generating a steady stream of money from your investments. Instead of aiming primarily for big capital gains, income investors look for assets that regularly pay out money, such as dividends from shares, interest from bonds, or rental income from property. The goal is to create a predictable flow of income, which can be used to cover living expenses, reinvest, or save for future goals. Income investing is especially popular with retirees, conservative investors, or anyone desiring predictable cash flow. Why does it matter? Income investing matters because it provides both financial stability and peace of mind. For many investors, especially those approaching retirement or looking for regular cash flow, income investing helps cover expenses without having to sell investments. It also encourages a disciplined approach to investing. By focusing on assets that pay regular income, investors often prioritize reliable, well-established companies or government bonds, which tend to be less volatile than high-growth stocks. This can reduce emotional stress during market swings and provide a sense of security. Income investing involves trade-offs. It generally carries lower risk than growth investing, but yields are usually smaller. Investors also need to consider inflation, since regular income may lose purchasing power over time if it doesn't grow with the cost of living. Taxes are another practical factor, as dividends and interest may be taxed differently depending on your situation. Here's a simple example. Imagine you own shares in a company that pays an annual dividend of £2 per share. If you have 100 shares, you receive £200 every year, regardless of whether the stock price goes up or down. You could reinvest this income to buy more shares or use it to cover living costs. Income investing isn't limited to shares. For example, a £10,000 government bond paying 5% interest would give you £500 each year. The principle is the same. You prioritise predictable, regular payments rather than betting on the stock price rising dramatically. What else should you know? Income investing usually involves companies or assets with a strong history of paying reliable dividends or interest. However, income isn't guaranteed. Companies can reduce or suspend dividends if they face financial difficulties, and bond interest depends on the issuer remaining solvent. Income-focused portfolios often include a mix of dividend-paying shares, bonds, and other income-generating assets to balance yield and risk. Investors also pay attention to metrics like dividend yield, payout ratio, and credit quality to make informed choices. Income investing works best with a long-term perspective. Reinvesting income can help compound returns over time, and maintaining diversification reduces the risk of relying too heavily on any single company or asset. To sum it all up, income investing is about generating regular cash flow from your investments through dividends, interest, or other payouts. It provides financial stability, reduces reliance on selling investments, and is generally lower risk than growth investing. While income isn't guaranteed and may be affected by inflation or taxes, a well-chosen and diversified portfolio can provide a steady and potentially growing stream of money over time. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.